Good morning. Already mid-October, and weekly price changes this week were mostly negative on the grains. December corn down 6 cents. November soybeans down 11. December Chicago wheat down 17, and Minneapolis wheat down 8 cents. The main issue, of course, was the changes on the Chinese trade war, a little bit of an acceleration by both sides. But on the positive side, November feeder cattle up $20 this week, up 20.47 to a new all-time 6,000 year high. Wow. Feeder cattle just rocking and rolling. Fat cattle following it, but not at new all-time highs, but a strong week as well. December crude down $2.05. Most of that decline was on Friday from the same Chinese trade war escalation. December gold up $92. Wow, silver got near the $50 mark and had a big downside reversal, but the recovery Friday with that Chinese trade war escalation. Then the stock market S&P index down a whopping 168 points after running to new highs this week. More than that, they actually lost like 184 on Friday. So that might be that was a big move on it, big on that escalation and trade war of China. Of course, Chinese trade war intensifies. On Friday, Trump responded to rare earth restrictions on rare earth metals, basically, that China has basically restricting now the export of it. And on Friday, Trump retaliated by putting restrictions on the export of software from the United States to China and 100% retaliatory tariffs as well, all in response to the restrictions on China exporting rare earth metals and things. So you're seeing an escalation here from both sides in the Chinese trade war. You know, they at first were snubbing soybean sales, but of course, the response from Trump for that was just giving money, Trump money to farmers for the tariffs, from the tariff money that he's generating mostly from China. So that kind of offset that. Now we're seeing an escalation beyond that, and actually restricting sales of their products. You know, you think about this whole situation, China has a problem in this trade war, intensifying it, because we import $450 billion from China. They only buy $150 billion of goods from the United States, 1/3 of what we're buying from them. Keep in mind, this whole deal where we're trading this much is because China produces $450 billion of goods much more efficiently than the US, to the point that they can even pay the transportation costs, shipping costs, and transport it to us. And still, the United States is ahead buying those products from them. And China also buys $150 billion from the US because we produce it more efficiently than China can. Soybeans is one of those products, purchasing about $7 billion worth of goods. Actually, I wonder if this isn't a positive development, that now we're getting into other products besides the 7 billion China buys from the US of just soybeans. Because if the pain is only in soybeans, that's not as bad as if they start restricting some of these other things. So I think that actually that short term, that's a negative, but long term, both of these countries benefit by trade. The United States, I think, started this problem because they're interested in that $300 billion trade deficit we have with China, reducing it. Of course, if China buys more stuff from us, 7 million in soybeans is one area. They could buy more grain from us, wheat and soybeans, or wheat and corn as well, and other products. So if this trade deal gets done, it'll be bullish ag. But whenever you have a Chinese trade war intensifying, it's bearish US ag, because we're selling. That's part of the products that we sell. You have to keep in mind other capitalist principles. You know, you have the right to produce and sell whatever products you want, or not sell them. and to set your price. Instead of charging more price for rare earth or software from the United States, we're choosing to restrict our sale of it, to make short-term pain, to try and basically negotiate better trade deals. If we can get the trade deal done, it's actually going to be beneficial to both China and the United States. They're actually inflicting more pain on each other in this trade deal to try and get the upper hand. The other principle of capitalism is you keep your customer happy. You've heard the saying, the customer is always right. Well, we are $450 billion customers of China for products that they produce more efficiently than we can. And China is $150 billion customers of us, products that we produce more efficiently than China, one of them soybeans, and maybe other grains as well. But let's look at, I think it's important to think about what impacts this escalation in trade war had on products, the ag products, because it was less than some of the other goods. So we had a down day in corn of 5 cents. Not all that dynamic, really, but of course a loss in corn as well, causing our loss for the week. And let's look at the soybean chart. 17-cent loss, certainly a big loss. We had gains in the week. Besides that, actually, we're in the middle of harvesting a crop. In our area, I bet there is less than 10% of the soybeans left to be harvested. Attention is now turning to corn, harvesting corn. Of course, we're harvesting potatoes, sugar beets, and other sunflowers and other late season crops. But actually, most of the soybeans are harvested. And actually, the yields are not as good as expected. We have a government shutdown still continuing. We missed the USDA October report this week. We have no crop progress reports or numbers. I think nationally, soybeans are probably going to be 75 or 80% harvested by Monday. That means harvest pressure may be just about over in soybeans, and harvest pressure might still, maybe we've only got 30 or 40% of our corn harvested, a lot of potential harvest pressure here as well. But you can see these charts are holding up pretty well during harvest. I don't think the yields of either corn or soybeans are as good as people expected. You can see the next week rainfall is going to be sparse in the Corn Belt, especially in this southeast. We're going to have a rapid harvest of corn and soybeans. I think soybean harvest is virtually complete this week. Week 2, temperature forecast is still above normal, but the precip forecast is shifting to wet, so that could slow down the corn harvest, or what remaining part of corn harvest. We'll probably have about half of it left by Monday of this week. Wheat, Chicago wheat market down, 7 or 8 cents on Friday. New lows as well. Actually, wheat might have been hurt on Friday by that Chinese escalation more than anything. And spring wheat, a new low as well, but not very impressive. Actually, spring wheat is still in a downtrend, but look at the impact on some of these other markets. Feeder cattle, the Chinese trade tension is actually causing feeder cattle to push higher. It appears to me that the United States, being a bigger importer of cattle than exporter, it looks like all of these trade wars are actually bullish the cattle market, the opposite impact of some of the other grains. Crude oil markets sharply lower on Friday, over $2 lower on Friday, and certainly new recent lows. It looks like the crude oil market is impacted much more by disruption of trade. Now, United States talking about restricting software, China and 100% tariffs on Chinese imports, and China restricting rare earth shippings to the United States, rare earth mining. So, wow, looks like a much bigger impact on crude oil than the grains or even the livestock. And finally, this might be one of the biggest benefits here, the countries are both going to be hurt bad. The stock market S&P index, huge declines on Friday in the United States, 184, I think, points. And obviously, after making new highs the previous day in the stock market. The fact that the pain is escalating beyond just soybean farmers might be the most positive thing for agriculture right now, because now that pain is expanded out to more than just the $7 billion of soybean imports, where China has been not buying any soybeans from the United States, but now we're restricting rare earth shipments to the United States from China, and the United States restricting software shippings and 100% tariff on China. This is going to cause much greater economic pain. And remember, both countries benefit from this trade. China shipping $450 billion of goods to the United States that they produce more efficiently than we do in the United States. That benefits both the US and China. And United States shipping $150 billion of goods to China, $7 billion of that being soybeans. That benefits China and the United States. So the fact that there's more pain now spreading into the other products, software, and rare earth metals, that is probably going to end this trade war quicker rather than a long, drawn-out process. And we've got to end the trade war for both sides, and it will benefit us economically, but that economic pain is expanding, and maybe that's the best news for soybean farmers. They're not alone in suffering due to this trade war. But the trade war is going to hurt both sides in the short term until it's solved. And so, obviously that's affecting ag prices, and, both in the negative side in the grains and the positive side on the cattle markets. But it's certainly having an impact on everything. So a lot to think about. Maybe this will be a shorter term problem, but for the time being, it is not beneficial for grain producers to have a trade war with China, our largest customer. Hope you have a great weekend and good marketing.